Hello. Well, what I had on the screen there earlier, that was the Chapter 4 Handout 2. Solutions to it. And if you need to know these, so what are the balances you should have. Any questions? I know you guys turned it in. By the way, I apologize for not getting everything graded. I ran out of time. Sorry about that. Yeah, but just so I should have those. I should have those up to date. If you're still having problems with your email or your Blackboard, we gotta get this sorted out. So if you're still having problems with your email, I should write this down. If you're still having problems with your email or your Blackboard, contact me and I will get a hold of tech people. Yeah. So if you're still having problems with your email or your Blackboard, contact me and I'll put it, if I can give them names for people to look at their accounts, and they should have it figured out by now. So if they haven't, by all means, contact me about it. Okay, Chapter 2 Handout 2, that's the one we just had up here. Any questions on that one? Most of you guys have already done it. So those are the solutions. This is the trial balance as we should get for the ending balances here. And this is the financial statements from it. What's any of those? Okay. Well, if you have questions on me, you also get a hold of me after class, and we'll put it back up. Okay, so today what we're going to do is go over this thing. Classified balance. Excuse me, Chapter 4, Handout 3, classified balance sheet. And then we're going to start on Chapter 3 Handout, which is the next chapter. And I will send out the Chapter 4 exam tonight. And it is due on Friday the 22nd. Oopsie daisy. Oh, that's not thought either. There we go. See, 5 or 6 tries and I'm right there. Okay, so that'll be the due date on chapter 4 exam. And they'll go out tonight. First, I'm going to do those chapter 3 handout, the balance, classified balance sheet. Okay. Yeah, I'm going to try something new tonight. I don't know if it'll work or not. Yeah. But I have I'm see if I can especially make my handouts they'll be the same as yours, except they'll be hopefully easier to see on the screen. Okay, well, this first one won't be needed. But anyway, this is our balance sheet, classified balance sheet, and everything is still the same. Assets, liabilities, equity, just like we've seen a dozen times. The only thing that's different is that we're going to have these different categories inside there. So these are all still assets. We're just breaking them up into different categories. And same thing over here. So everything is really the same as we had before, except that we have different categories. And the reason we have these categories is so that people know where to look for stuff. You know, I think we talked about, before that if you're going to a store and you want Cheerios, you go to the cereal aisle. Everybody knows that. You don't have to be told it. It doesn't matter what store you're in. You're going to go to the cereal aisle because that's where you expect to see Cheerios. It's the same thing on the financial statement. When you're looking around at all these accounts, it's nice to know where to look to find them. So that's what this classified balance sheet is all about. Okay. So we'll go over some of these things and just what they, what they are a little more in depth. Okay. Current assets. These will be turned into cash or used within 1 year. So these will be turned into cash or used within 1 year. Now let's make that. Yeah, let's not do that. Okay. So current assets. And for instance, cash is already cash. Accounts receivable will be turned into cash. Allowance for doubtful accounts and accounts receivable go together. Some of you have mentioned, well, what if you don't collect the accounts receivable? We have these accounts receivable, people lost money, but sometimes they don't pay. So what do you do with that? Well, we actually have an allowance for it. We'll say, okay, we're not going to collect some of these. So, it would look like this. I'll give you an example. For instance, oops. Hey, what's going on here? For example, you may have accounts receivable of 10,000, but maybe you think that you're not going to be able to collect 1,000 of that. Sometimes people can't pay. They go bankrupt. They die. They leave the country. All kinds of things could happen that means you're not going to get them. So what they would do is they'll call these the net accounts receivable. Oops. Oops. Something weird's happening. So this would be say 9,000. And so what we'd be telling people that they're looking at our financial statements is this: look, don't don't expect, we're owed 10,000, but don't expect that. Because of the past, we know that some people just aren't going to be able to pay. So this is really the number to look at, is the one that's left over here. The 9,000. 9,000 is more realistic what we're going to get out of this. So this allowance for doubtful accounts. We actually have a chapter on this we'll talk about later, but it's this is what really the number that we were expecting to get out of. So this is a contra account, like the depreciation expense, or committed depreciation. So these two kind of go together, these two accounts here. Yeah, okay. Marketable securities and short-term investments. These are when you invest in a different company. Man, you can't see that at all, can you? That's a little bit better. Okay. So marketable securities and short-term investments, so those are exactly the same thing. It's when you take money and invest it in another company. Now, this is within 1 year. So this would be something like, okay, we're going to take some money and invest it in, say, IBM stock. But we're only going to do it for the next 6 months. We think in the next 6 months, IBM stock is going to go up. So we'll take some money and put it in IBM stock. That's marketable securities or short-term investments. Marketable securities is the new terminology. It's the one people should be using. Many times they don't. They use the same, the short-term investments. It's exactly the same account. So these are all kind of pretty close to cash up here. The rest of the stuff is a little bit further away. Supplies, inventory and merchandise are the same thing. That's the stuff that supplies are things that are not sold. You use them. Inventory is something you want to have sold. You sell them to the customer. So, for instance, a grocery store, if they have apples, apples are inventory. They want to sell them. If they have cleaning supplies to clean the counters, that they're not going to sell that. Well, I guess they do sell it. Grocery stores are a bad example. I'm trying to think what they have. They wouldn't be selling it. Actually, most of the stuff in the grocery store you think about, they also sell it. So I'll think of something. But I know. Suppose that they have aprons for the people to wear. They probably don't sell those exact aprons anyway to people that they would. Those would just be supplies. And prepaid stuff we already know. Current liabilities are the same thing as current assets, in that they are within 1 year. So you'll see all of these liabilities are basically the same liabilities we've seen before, but up to 1 year. Okay, now here's the thing about the classified balance sheet. So these two are all short term. These are everything else is long term. So anything that's more than a year will be underneath here. All of these are long term investments, property, plant, and equipment. Land's going to last for more than a year. Equipment's going to last for more than a year. Buildings last for more than a year, that sort of thing. These are all longer term after this. So these two up on top here, these are the things that are only going to happen in the first, within a year. These down below are for more than a year. So all these ones down below here are for more than a year. Okay. Long-term investments. So if we buy IBM stock and instead of selling it in 6 months, we're going to sell it in 6 years, we'd be in long-term investments. Land held for future use. I'm going to hold off on that one. I'll talk about it in a minute. Property, plant, and equipment. Land is the property. Let me zoom in. Land is a property. Buildings would be the plant. And equipment is equipment. So property, plant, and equipment. And again, these are the longer term stuff. And by the way, when you look at a company, this is kind of what you usually see. You see, their buildings and equipment and all that stuff. This is the most visible part of a company, the property, plant, and equipment. Intangibles. These are things that the value is not tangible. You can't put your hand on the value. On these things, you can. A building you can walk into, there's a tangible value to it. You can walk in, it's raining outside, you walk in the building, you're dry. Down here, there is no tangible asset. You can't put your hand on it. For instance, a copyright. If you make software or if you write music or a book or whatever, you get copyrighted. The value of the copyright is not in, is not tangible. You say, okay, well, I got a copyright, I can put a piece of paper. Yeah, but the value is not in that piece of paper. It's in the right to use that, that copyright for music or whatever it is. So these are intangible. Now, they still have a value. Some of them are very valuable. Copyrights can be very valuable. So it isn't that they don't have a value. They do. And in some cases, for instance, like drug companies, they're in the billions of dollars. They have values, and they'll have several tens of billions of dollars of intangible assets. So these intangibles, but again, the value is not something you put your hand on. Okay, other assets. Oh, I didn't touch on them. I should go to this one a little bit. Yeah, I'll forget. Other assets are basically anything that doesn't fit into the categories above. There's some wacky ones in here. There's pension stuff in here. Sometimes there's, if you have an old truck. That you're not,
Example
for other assets?
Yeah.
All right. The old truck.
Old truck.
No longer used. Okay, so we have an old truck that's no longer used and we're trying to sell it. So we're trying to sell the old truck. Okay, so we have this old truck, we're trying to sell it. Now, it will not be up here in property, plant, and equipment. Property, plant, and equipment is not something that's for sale. Property, plant, and equipment is stuff that you're using. This is what you're using in the business. So this old truck, you're not using it. You're trying to sell it. It's not a current asset. It's a truck. It's a long-term asset. So it would go down there with the other assets, waiting to be sold. And once it's sold, it'll take that off the books. There's a few wacky things that go in here too, but for the most part, the other assets are going to be things that are kind of outside the normal business. The rest of the stuff will be, most of it will be, 99% of it will go up here, and there'll be a few wacky things down here sometimes. A lot of times companies don't have anything in other assets. Most of the stuff will fit into those other 4 categories. Okay. Onto the liability side. The other liabilities we have are long-term. So these are more than 1 year. Okay. So these are things that are going to be paid off, but in more than 1 year. Let's say mortgage payable. That's probably the one that most people identify with. So if you have a 20-year, 30-year mortgage, you're not going to pay it off for 20 or 30 years. It's long term. If you have a note payable that's more than a year, a 5-year note payable, something like that. Bonds payable, I don't know if I talked about these or not. Bonds are kind of like mini loans. It's when you have usually a very large amount of money you need to get, and you kind of break it up into a bunch of little loans so you can, get loans from a whole bunch of different people. And they're usually long term. They're usually, they can be several years. Disney used to have 50-year ones. I don't know if they still do or not. They had 50-year bonds, and they thought that no one would buy them, and they did. So, okay. The equity section is exactly the same. This is all the same. The only thing that, and this is, again, this is all the same. This is the only thing that's a little bit different here is treasury stock is kind of a weird one. That's when the company buys back their own stock. So they have fewer owners, and that's why it's negative. For instance, if IBM says, okay, we have some extra money, we're gonna go back and buy our own stock back. We're gonna go on the stock market and buy back our own stock. And if they do that, it goes what they call treasury stock. It means there's fewer owners. If they buy $5 million of their own stock, that means there's $5 million less of the owners out there. So that's treasury stock. Many companies don't do that. Some do. I guess Apple's doing that now, trying to buy back a lot of their stock. Now, even though we have all these different categories now, get rid of this stuff here. It still is the same, though. It still is the the assets. Let's get rid of this thing. Assets. We have different categories now, but the total assets are going to equal the total liabilities and equity. It still has to balance. These two at the bottom will still be, they have to equal. It's just putting things where people would expect them to be. And I'll give a little bit of an example when we get done with this one about how it can also kind of help managers have more information, basically. Okay, well, let's jump into one here. And my sheet is going to be, hoping that this is a little more, you can see this a little bit better. It's going to be a little bit different than yours, but hopefully it'll be able to be seen on the same screen. So this is number 2, and we have our trial balance, just like we saw before in the first 2 handouts. And we're going to go through and put each of those over here. Now, one thing is that not all companies will use all these categories. many of them won't. I mean, many of them won't use some of these categories. But you can still do a classified balance sheet. It's just whatever classifications they need. Okay, so what current assets do we have? Now, these are all the assets. Which ones of those are current?
Cash.
Yep.
Accounts receivable, inventory, and prepaid insurance.
Yep. Accounts receivable, inventory. Okay, let's put some numbers with those. Feel free to cut and paste those, obviously. Okay. So I'm going to put this into a total here. I'm going to say total. Current assets, adding all these up. Time for my handy calculator here.
22. 23. 23,700.
I don't know.
I'm trying to calculate it off it, and I think it's 23,700.
Just 23,700.
Yeah.
Okay, so these are the total. So those are the total current assets. Okay, so property plant. Well, first of all, do we have any investments? I don't think we have any long-term investments. There's nothing here that says investment.
No.
Okay, so what goes in property, plant, and equipment?
Land and equipment.
Yep, and one more thing.
Patent?
No.
Oh, accumulated depreciation.
Yep. Okay, so we have land. Equipment. And accumulated depreciation. Okay, so the land was 28,000.
28,000.
Now, the equipment really isn't worth 40,000. We're going to depreciate 11,000 on it. Hey. Oopsie. Try something here. There we go. Okay. So we're going to have total
68 minus 11. 57.
37?
57, yeah.
Okay. So our total property, plant, and equipment is 57,000. And the last one here, the patent, is an intangible. And again, a patent, if you get something patented, it's an idea. And to encourage people to come up with new ideas and progress civilization and all that, they're granted patents, and patents give them usually 20 years to use that patent exclusively. So if I come up with a new way of making whatever, chocolate milk, I can use that patent for making chocolate milk, and no one else can unless they get my permission or I license it to them, whatever. So a patent is the right to use an idea, basically. And the value isn't tangible. It's just the right to use that idea. So it's going to be an intangible asset. And patent. And again, so for some companies, these are huge. If you like medical companies and stuff like that, these can be billions of dollars in intangibles. They spend all this money to develop, these drugs, but then they charge crazy amount of money for them. So they're worth a lot. Okay, so this is we probably don't need to do a total on intangibles. There's only one there. So all these three together are still going to be our total assets.
1,000 plus 57 plus 23,700. 81,700.
Yep. Okay, so we have 81,700 total assets. And again, the balance sheet is exactly the same. Assets equal liabilities plus liabilities. We just made a few more categories. Okay, let's go to the liabilities. Which liabilities are current?
Accounts payable, salaries payable, unearned revenue, and bonds payable.
Oh, I lost I did something bad here. It's over, I think. Lost my number column over here. Hopefully you guys don't lose your number column. Okay. All right. Yeah, so accounts payable, salaries payable. All right, so 4,000.
So bonds payable is long term, right?
Yep. Yeah, so this will be our total. I'll put it here.
So 5,900, 6,300. 6,300.
6,300. Thank you. So that's a total current liability. And this, yeah, this bonds payable, it's in 8 years, so this is gonna be long term. Ah. Yeah, since we only have the one here, if I don't need to do a total on it. Okay, equity section. Equity section is gonna be exactly the same as we had before. There's nothing different on the classified balance sheet for the equity section.
I have common stock written in. It's 33,400.
To move this up.
Total equity.
Okay, so this will be total.
Total equity would be 41,400.
41,400. Thank you.
Yeah.
And total liabilities, and it's probably cutting this off, isn't it?
So we have 41,400 plus 3,400.
Not gonna let me bring it up.
Okay, plus 6,300. 81,700.
Hey, there we go. Okay, so yeah, so 63 plus 34 plus 41. Hopefully comes out the same.
Yeah, it is the same, 81,700.
Yep.
I still have a question.
Yeah.
You were saying the only difference in these, the first balance sheet that we were doing and this one is that it just gives the managers more information. Am I correct?
Yeah, exactly.
Okay, just trying to make sure.
Yeah, and here, I'll give you an example. Let's see here. Let's take the current assets and the current liabilities.
Mhm,
So the current assets are basically things you're going to be turning into cash in the next year.
mhm.
And the liabilities are things we have to pay within the next year. So having said that, does it look like we're going to be able to pay off our liabilities in the next year? The current assets are going to be turned into basically cash, let's say.
Oh, yeah.
And the liabilities, these are things we're going to have to pay in the next year. So does it look like we're probably going to be able to pay our liabilities or not in the next year?
Yes.
Yeah, we have these current assets, and this stuff, accounts receivable will be turned into cash, and inventory will sell, and prepaid insurance will use, for part of the business. But yeah, basically, we are going to be able to pay our liability, and this is what you'd look at. This is what you hear about people who are company analysts for they'll analyze different companies, General Motors, Google, whoever. this is kind of what they do. They'll look through and they go, okay, we got all these current things together. This is what we're going to bring in the next year. This is what they're going to pay out. Okay, it looks like they'll be okay. It looks like, they're going to be able to cover this amount. And they do this for all, there's legions of people that do these kind of analysis for different companies. But even a small company, like if you go into a bank, they want your financial statements. I need to get a loan from the bank. They'll want to see your financial statements, and they'll do exactly the same thing. Okay, are you going to be able to pay off your current liabilities in the next year? How well are you set for the next year, and so on and so forth. So these are all. It just gives it more information that you can actually use. It's putting it in a format that's more easily usable by managers. Yeah.
Okay, thank you.
And again, it is just assets equal liabilities plus equity. The accounting equation is exactly the same. It's just more categories. It's like the grocery store with, they have an aisle for soup, and they have an aisle for cereal, and an aisle for whatever. Same thing. That people know where to look for things. Any question on that? Let me back it up a little bit so you can take a look at it. Okay, now the Chapter 4 exam. Chapter 4 exam is going to be a different one in that we're not going to have any multiple choice questions or anything. The Chapter 4 exam, I'm going to give you guys an accounting cycle. So we already did 2 of them. These are the accounting cycle ones. These things. So I'm going to send out, and the reason why I'm doing this, I want to emphasize this, is that just to get people more familiar with using kind of the nuts and bolts of accounting. How does it actually come together? And so that's why I'm kind of focusing more on this than say on the classified balance sheet. But anyway, I'm going to send out a basically it's this accounting cycle one. They're all different, the different numbers in that, but very similar format. And just to get used to doing them. I mean, that's really what we're doing with these, is just getting familiar with them. So anyway, I will be sending that out after class. The exam will be based on the accounting cycle. The Chapter 4 handouts 1 and 2. This one we just did. Not that this isn't important. It's just not as important as the entire accounting cycle. So, but and we'll talk about this more later on in classes. The different things in here. Okay, any questions on that? Okay, well, I'll tell you what, let's go ahead and take a break. It's a little bit early, but we'll take a break, and then when we come back, we'll start in on Chapter 3. And the Chapter 3 stuff will not be on the Chapter 4 test. The Chapter 4 test is only going to be, let me write this down. The Chapter 4 exam. So this will only be on the accounting cycle. It won't be on anything else. Just be doing the accounting cycle. And again, just to get familiar with it, if you do something, it's not easy. You do something once, you're vague on it. You do a second time, a little bit better, but more and more. I'll tell you a funny one. I was putting in lights actually in this basement here. I was putting in lights in the basement here, and I was working with my father-in-law. And I put in 7 of these lights, these things, and we had to move one of them. We bring in the ceiling and move one of them. And I couldn't remember, I put in 7 of these. I couldn't remember how to take it off. I don't know, pulling at it. And my father-in-law, Mark, just take it out. I can't remember what I did. But so, point being that even if you do 7, sometimes it's, the more you do, the better. I'll put it that way. Okay, so the next thing we're gonna cover though is the chapter 3 handout. So if you wanna pull this one up and let's say be back at 6:47, let's say 6.
7 o'clock.
I'm sorry,
I just said 7 o'clock.
7 o'clock?
Yeah,
Okay. All right, we'll do 7 o'clock. Be back at 7.
thank you.
No, you guys aren't gonna all leave then. By the time you by the time you realize we're not here, it's too late. Okay. So we will. Okay. So today we're going to start on chapter 3, which is, I think, one of the more difficult chapters in the course. But we're not going to finish the handout, but we're going to go through some of it tonight, and we'll pick it up again next week. So let's look at it. The adjusting entries. And they mainly come about because businesses they have financial statements made for a specific period of time, a year, a month, or whatever it is. And these are kind of artificial. They call it the definition-y term of it is periodicity. You can put something into a period. So it could be, a kind of an artificial period. So we usually go about, making financial statements for 1 year, say. And it's kind of an artificial period because a lot of times the transactions don't fit in there. And the one I give here is, suppose you have a truck that's going to last for 5 years. So the period that truck covers is 5 years, but we can't wait 5 years to make our financial statements. So every year we put out financial statements. Well, that causes a little bit of a problem because we have to take a 5-year transaction and fit it into, put a portion of it into a 1-year financial statement. So that's kind of the gist of the problems that we have with this, what they call periodicity, putting stuff into a 1-year period, for example. So what we try to do is adjust the accounts so that the revenues and expenses are recognized in the period in which they belong, basically. So, for instance, revenues from 2021 should go with expenses from 2021. And down here, this might be a little confusing, but you could have things that you pay cash for that are going to last for many years. There could be things that the cash hasn't been collected yet. For instance, accounts, you sell something on account in December of 2020, and you get the cash in January of 2021. Well, you have part of the transaction in 2020 and the other part in 2021. So there's all these kind of things that go on here that can cover more than one period or span more than one period. And we have to try to get, just the stuff that, for instance, belongs in 2021 in 2021. And do the same thing for every year that it comes on. And so you could have things that go into many years. It is possible you have something that is completely contained in 1 year. I mean, that happens too. But so these are what we call adjusting entries. Now, adjusting entries, they have to have either a revenue or an expense. So they have to have a revenue or an expense. So revenue or an expense. They're not going to have both. They're only going to have one. So it's going to be a revenue or an expense. An adjusted.
Could there be any time they have both under adjustments?
No, it would be either or. It'd be one or the other. So you're either going to have a revenue to adjust or an expense to adjust. And it comes to up here. This is, they were talking about basically revenues and expenses. So there has to be a revenue or an expense to adjust. And it's going to be one or the other. And for revenues, we basically say, okay, how much was earned? This is kind of the question that we answer with that one. And for expenses, we say how much was used. That'll give us the amounts. Now, the nice thing about adjusting entries, the calculations are tricky. They can be tricky. But the actual journal entries themselves are somewhat easier because there has to be a revenue or an expense. And what do we know about revenues? They're always credits. What do you know about expenses? They're always debits.
Debits.
So the debits and credits should be okay. You know, as long as we get a revenue or an expense, you know, the actual journal entry is usually not the problem. It's usually coming up with a number for it, which is a little tricky. Now, another thing about it is that they have no cash. These adjusting entries will not have anything to do with cash. The cash will have been paid either beforehand or after. But at the end of the period, the cash isn't being paid. It's either being paid before or after. So when we're making these adjusting entries, they're made at year end, and there's never any cash involved. So a revenue or an expense, no cash. All right, so let's see how all this works. All right. Prepaid adjusting entries. Okay, so on April 1st, when 1 year insurance policy was purchased for $1,200. The cost of the insurance was $100 per month at the time the filing was made. Okay, how did they come up with this $100 per month for the cost of the insurance?
Is it from the 1,200 divided by 12?
Yep. So we had $1,200 divided by 12 months equals okay, so it's going to cost us $1,200. Excuse me, $100 a month. We pay $1,200, so every month it's $100. This is the journal entry we made. This is the correct journal entry. We don't have to do anything with it. We paid cash. We got this prepaid insurance. Now, this is where it gets a little tricky. We have to figure out, we bought it on April 1st. So we have to figure out how many months have we used up in 2021. Now, we're going to take all of April because we bought it on the 1st of April.
June, July, August, September, October, November. So we used 9 months.
Yep. Yeah, so we used this thing we used up 9 months of this insurance. So 9 months times, here's my being lazy, $100 per month equals what, 900? Okay, oh, we got a lot of space here. More space than I thought I had. Okay, so. Well, let's take a look here at this. So we've used up, right? We've used up 900 of this insurance. So this prepaid insurance is really not worth 1,200. We have to take out 900 out of it.
300 or 900?
We have to take out 900, but I know what you're saying 300 because that's what's going to be left in it. We're going to take out 900 out of it to get it down to 300.
Right.
So
I thought we used 900. So why are we taking 900 out?
because that's what we used up. So this 1,200, we have to take it out. We have 1,200 sitting in there as an asset, but we use 900 of it, so we have to take 900 out of that asset. So this is sitting on the books right now at 1,200. It's sort of like this down here. I'll put it over here.
Please, I don't get it.
So we have 1,200 sitting in that account.
That's right.
Now, you're right. There's only going to be 300 left, right?
Yes,
So how much do you have to take out of here to get it down to 300?
900.
900. So that's why we're doing it this way. Yeah. So now this prepaid insurance has a,
Oh, it's prepaid. Okay.
yeah, this prepaid. So this prepaid insurance is a debit. So to reduce it, are we going to debit it or credit it? We have to reduce this prepaid insurance. Right now it's got a debit balance.
We credit the 900.
Yep. It's an asset going down. We're using it up for 900. Okay. Let's go back up to here for a minute. And are we going to have a revenue or an expense for this? What do you think?
It's going to be revenue because we credit in it.
Nope. No, so we're going to be either if it's a revenues would be credit, but we need the other side of this.
So the expenses, we are,
Exactly. How much of it was used? So this is how much was used up.
so 900 was used.
Mhm. Yeah, so we're going to have some kind of now. What would the expense be? What would we call the expense? Probably. The prepaid insurance. So we probably call this insurance expense. So this would be the adjusting entry. Get rid of these rows here. So we're going to expense 900 of it. That's how much we used up. And so this is what this would look like. The way to those T account things that we just did. So the debit here will be for 900 for we're also going to Let's try that again. We're also going to take this 900 out of this account. So this will be the prepaid account. We'll have 300 left in. So this will be on the amount that will be on the balance sheet. And this is what will be on the income statement for you. So we only have 300 left of prepaid insurance. We used up 900 of it. And at 900 that we used up, right? How much was used?
900.
Yep. So the journal entry for this one will always be what was used. Now, if this stuff looks wacky, it should be. The calculations are kind of tricky. And then also we got to put it into that weird 400-year-old shorthand that we call journal entries. So, you know, if this looks strange, it should. This is it'll be one of the strangest things that, you know, we'll cover. Okay. Any questions on this? Well, luckily, there's a similar one on the next page. Okay, and this one is on October 1st. One-year insurance policy was purchased for $3,000. The cost of it was $250 per month. And how did they get that?
3,000 divided by 12.
Yep. So that's how that came about. Okay, now here is the tricky one that I gave you no help on. This was bought on October 1st. So at year end, at December 31st, how many months worth of rent did we, suggest that? How many months worth of insurance did we use?
3 months.
Yep. We bought it at the beginning of October, so we're going to use all of October. All of November and all of December. So we used 3 months worth of this. So 3 months at $250 per month.
750.
Be lazy, yeah.
3 months. Times 250.
Is it 750, right?
750. Yeah. 3 times 250. 750.
Okay. And this is where I got that 3 from. It's for the 3 months here. That's where that comes from. We had it for the last 3 months of the year. So 3 months times the $250 per month. Okay, now our journal entry. So we have to take, we've used up 750 of this. So we have to take 750 out of this prepaid insurance. And we're going to put insurance expense for 750 on the books. And again, expenses. Always, well, I should say always, but they're virtually always debits. So insurance expense. So we have these, we paid cash. Now notice we're not paying cash again. We already paid for this insurance, so we're not going to pay it again. There's not going to be any cash. There's no cash in there. This adjusting entry note here. So on this adjusting entry, we're going to simply take what we used, in this case, 750, and we're going to take it out of the prepaid insurance. Okay, prepaid insurance had 3,000 in it. We just took out 750, so there is 2,250.
Yeah.
So this is our ending balance in our prepaid insurance. We've used up 750 of it. And we will have insurance expense. So this is what will be taken away from our income. We've used up 750 of the insurance we purchased. We still have 2,250 that we'll use in the following year of the insurance. But again, this is one of the wacky things is when a transaction doesn't fit all into 1 year, it goes into another year. So the question is, how much do we put in this year? So we'll put 3 months in 2021. How many months will be in 2022?
12, but we have 7. We have 9 already.
Right. So exactly, it would be nine months of this insurance will still go into the next year. And you're right. There's 12 months in the year, so that you have to get more insurance in October of next year. Yeah. So these are the kind of the accounts what would be left in them. Okay. Now, here's one where I am no help to you guys. I don't tell you how much it is per month. I don't tell you how many months it is. So I will be quiet and see if you can figure out the entry for this one.
I can stress 1 year insurance purchase for 600. Yeah. 600. So it's going to be 600 divided by 12. Okay. So $50. $50, and that's in August. So 1, 2, 3, 4, 5. 5 times 50. Okay. That amount is supposed to be 600, not 500. Yeah.
Sorry, thank you. Oops, wrong place. Okay, 8. Okay. Okay, so our okay, so this prepaid insurance is going down by 250. And so we'll have prepaid insurance was 600.
Yeah.
We used 250 of it, so now it's what, 350? So there's 350 left in there.
Yep.
Maybe these are making it more confusing, but so we only have 350 left in our prepaid insurance, which is what we should have. We used up 250 of it. And we're gonna recognize that we used up 250 of it, and that's insurance expense. So we're expensing 250 of that insurance. And again, no cash. So when you're doing these adjusting entries, there's no cash involved. Just because the cash has either already been paid or it hasn't been paid. In this case, the cash has already been paid up here. Right? This is the you know, the cash has already been paid. We're not going to pay it again. We paid for the cash in August. So when we do this entry down here, we're not actually paying for anything. We've already paid for it. We're not going to be any cash. We're just going to say, okay, we have less prepaid insurance now because we've used up 5 months of it, and we're going to expense those. You know, that we've actually used up those 5 months worth of the insurance. Question on that? And by the way, you know, these are wacky. They are. I mean, on top of being this weird 400-year-old shorthand, you know, the calculations and trying to get them in there. I know I've told you guys this before, but I was doing an audit one time and they had put an adjusting entry in thought it was wrong, took it back out, and said, okay, wait, no, it's right. And they put it back in. They took it out, they put it in and took it out 6 times because they were unsure of it. You know, sometimes it just, it's hard to tell, you know, how to do it. The concept is real easy. I mean, the concept of these is, you know, get revenues and expenses in the correct year. Easy, okay? Get the 2021 revenues and the 2021 expenses. Easy. The actual, you know, how you do that is a lot trickier. Okay. We're gonna do depreciation. Wait a minute. No, we won't. We'll on your revenue. All right. Okay, unearned revenue. In unearned revenue, this is when a customer gives us cash. Well, first, let me stop for a second. Are there any questions on this one? On number 4?
No.
Not from me.
Okay. All right, so let's go to this unearned revenue. So unearned revenue, it's kind of the opposite of what we normally think. Normally think we do the job and then we hand someone a bill and they'll pay the bill. That's, you know, we've done our work. They just haven't paid us yet. This is just the opposite. Someone's paid us, but we haven't done anything. And notice that the cash has already changed hands. You know, they've already paid us. You know, they're not going to pay us anymore. You know, we got to work off this unearned revenue, which really isn't a revenue at all right now. It's a liability. Because if we don't do anything, we got to give them back $3,400. Okay. Closer to each other. So at year end, 1,800 of the unearned revenue had been earned. Make the December 31st. Who wrote this stupid thing? Make the December 31st adjusting entry for the unearned revenue that was earned. Okay. Well, let's think about this for a minute. Are we dealing with a revenue or an expense in this case?
It's a revenue because we were paid.
Yeah, exactly. It's a revenue. So this is going to be a revenue. I'll put it down here at the bottom. So, you know, we're dealing with a revenue here. Let's get rid of this. So we're talking about a revenue here. We're going to earn this money, right? They say at year end that we earned 1,800 of the unearned revenue. Okay, so what accounts are we going to use? And remember, we're not going to use cash. The cash has already changed hands.
So we will use revenue accounts
Good.
and unearned revenue.
Good. Now revenue. Good news about revenues. Your credits. So how much was earned? 1,800.
1,800.
Revenue. These are all his credits. And we have this unearned revenue. And now we've earned 1,800 of it. And unearned revenue is not a revenue at all, it's a liability. And it's going down. We're now earning this money. By the way, if you want to look at this revenue, if you want to put this as earned revenue, there's nothing wrong with doing that. By definition, revenue is earned. But if you want, in this context, thinking about what's earned and what's unearned, this is, 1,800 had been earned. So in other words, it's no longer unearned, it's earned. So we earned that. Okay, now, so let's take a look here. So this will be, the revenue here. And sometimes you'll see some places will put down that it's earned revenue. This is the completely out of the question to have that. Now the unearned revenue. It started out at 3,400. So they gave us the money, 3,400. Now we got to do the work. We've earned 1,800 of it. And we still owe them some amount.
1,600.
Yep, 1,600. So this is what we still owe them. And presumably we'll do that work in the following year. We've earned 1,800 of it, so we're going to count that as earned. So this 3,400, we've earned 1,800 of it. Or whoever, not us, but whoever did this. And again, no cash. Why? Cash already changed hands. They already paid us. They paid us in November. They're not going to pay us again. We got to do the work first. Okay, let's go down to number 6. And this is the one we were looking for today. This is the last one we're doing. So, and this one is very similar to the other one with one exception. They don't tell us a dollar amount. They give us a percentage that was done. And that looks confusing the way I just did that. So 70%. Or point. Isn't that annoying? These are my pet peeves, is that all these computer programs and stuff now, they try to guess what you want to do. It's so annoying. No, don't guess what I try to do. You do a search. It's like, oh, do you mean this? No. Search for what I just gave you, But anyway, so they're telling us that 70% of it is done. And by the way, this isn't unusual in business. I don't know if any of you guys work for construction companies or something like that, but a lot of times they'll use percentages. They'll say, okay, we've used 80% of the materials and 40% of the labor or whatever it is. So it's not unusual to have it done in percentages, but it's just another layer of working out. So to see how much we've earned. So 5,000. Times, if you have a good calculator, you can put 70% in. Yeah,
I will try.
you have one like mine. It's not very good. You just put 0.7 in.
3,500.
Yeah. Oops. Okay, so 3,500 of it was earned. And then the journal entry is the same. We're going to pick up the revenue, all those credits. And if you want, you could put in there that it's earned. You don't need to put that in at all, but it makes a little more sense that way. By all means, do it. And you will find companies that'll say earned revenue or revenue earned. And unearned revenue, which is actually not a revenue at all, it's a liability, is going down. We've now earned 3,500 of it. And so you always, the journal entry is always for either the amount that's been earned or the amount that's been used. It is not what's left over. Okay, so it's for the amount that was earned or used if it's an expense, but it is not what is left over. What's left over will come out of it. But okay, so let's see here. So this is let's do the revenue first. So we've earned 3,500 of this thing. And unearned revenue, it started out at 5,000. And we've earned 3,500 of it. So we still have 1,500 that is earned, and you do not need to make any entry for that 1,500. It'll automatically be what's left over. So this is what we still owe. We still owe 1,500 of work. Again, that's not in the journal entry though. The journal entry is for what was earned. And we pick up revenue of 3,500. They gave us 5,000, but we've earned 3,500 of it. So we're going to recognize 3,500 of it that we've earned. And again, this is a transaction that's going to go into more than one period. So into 2022, I would assume that we're going to earn the rest of this next year. You know, the remaining 1,500 will probably finish it next year. Any question on that? Okay, let's stop there. Accounting is just so much fun that, you know, you got to be careful you don't overdo it. That's.
It's just a fun.
Huh?
You just say it's fun.
It's fun, right? And, you know, I don't want you guys getting, you know, I know how young people are. They just love accounting. They love it. So, yeah. So anyway, yeah, so we'll stop there and then we'll pick it up next time. But again, this is the toughest chapter. So if this seems very unfamiliar, it should. It's kind of wacky calculations, and then you have to, on top of that, put it into this weird shorthand that uses debits and credits, which is kind of strange. Now, the nice thing about these journal entries, though, is they, you know, if you remember the rules of, this. You know, that there's going to be a revenue or an expense, never both, one or the other. And then just focus on how much was earned or how much was used. And that's it. You know, and once you realize that, you know, if you get a revenue or an expense, at that point, you know what the debit or the credit is. And you know what the other, whatever's on the other side has to be, you know. So for instance, if there's a revenue and it's a credit, whatever's on the other side has to be a debit, because they have to equal. And just the opposite down here. Expenses are debits, so whatever on the other side has to be a credit. So anyway, and also that there's no cash, that we don't use cash in any of these. The cash has already either changed hands or it hasn't changed hands yet. Question on that? Okay, so what's gonna happen now is I'm going to send out the Chapter 4 exam, which is only gonna be the accounting cycle. None of this is gonna be on there. Oops, wait a minute. Here's the one we're just doing. And it'll be due a week from tomorrow. Questions on this? Okay, well, I'll stop there and have a good evening, have a good weekend, and I'll send out the Chapter 4 exam. And again, it's just the accounting cycle. And I plan to be all caught up on the grading by tomorrow. So, I'm sorry?
Thank you.
Thank you.
Thanks, guys.
Thank you. Good night.
Thank you. Bye-bye. Good night.
everybody.